Thank you very much, and thank you all for coming here today. We know the markets have been very busy and difficult, so you took time of your day to come and watch us. So we'll try to make this as interesting and inspiring and insightful as possible, yeah? I would start by allowing each one of the panelists who maybe 30 seconds to introduce yourselves, and then we can start with the questions.
Thank you. Good afternoon. My name is Jay. I'm the CEO of STARprime. We're a challenger firm in the liquidity and market making space on a mission to redefine the standards of liquidity provision in our industry and use my little hashtag liquidity redefined.
Hello everyone, my name is Wei. I always say I'm the only way to make you remember my name or how to pronounce my name. I'm the managing director of ATFX Connect Global, which is institutional arm of ATFX Group.
So my name is Victor. I'm a general manager for Bridge at Spotware. You know, Spotware is a company that produces CTrader, a trading platform. So it's our attempt to move further in building the ecosystem. This is why we're rolling out Bridge, the bridge that allows brokers to cost their fees by a lot. We're charging brokers not volume-based fee, but infrastructure-based fee. So I hope I will contribute to this discussion because a lot of what we'll be discussing has to do with liquidity bridges and fintech technology in general.
Hi guys, Dane here, the Chief Commercial Officer at Kamma Capital. We also are a broker and tier 1 liquidity provider. I think most people know me now by the tagline of Kamma Gold. So hopefully the topic we're speaking about today is going to be focused more on gold, and I'm sure I'll be able to give you some good insights around that.
Hello everyone, my name's Nick Surf. I'm EVP of Trading at Equiti and Equiti Connect. We are obviously a broker, a big retail broker, and if you are looking for good liquidity, please come and see us.
Thank you all, and I think you guys can see that we have a group of really good experience and well-diverse panelists that can give us a lot of insights today. And I think, you know, we've started kind of arranging to speak about topics of liquidity. We've had a lot to cover actually today, but given the recent movements, we were just discussing that we should give a lot of priority to what's happening today in the gold and silver market. And we're going to be tackling that in a sense of we're not going to forecast where gold and silver is going, but we're going to try and talk a little bit about how these volatility changes have changed the liquidity structures, the spreads, the execution metrics that we all look at. And this is something very important because I don't think we're out of the woods yet. We still have a long way to go, and how we're going to tackle the next couple of weeks to the next couple of months are going to be very important. So I'm going to start by asking this general question, and so we can get the ball rolling. How do you see the changes in gold specifically and silver liquidity after the volatility that we've seen in the last couple of weeks? What changed? Why the spreads are kind of going wider now? Is that a protection mechanism from the banks? Is it your own pricing that you guys are trying to be protective? Can we try and kind of explain to people why these changes are happening and how does that volatility affect the actual underlying liquidity of the asset? Jay, you want to start?
Thank you. So I think there's many different elements that can shape our understanding of what's happened to the general provision of liquidity, particularly gold and silver. From a perspective I see a lot of is, I wouldn't call it fear, but I would just say there's a limited amount of willingness to participate. And we're seeing that across a lot of venues upstream from us. You know, NOP limits are much smaller. People are willing to post less capital margin at each other. So the size of the industry from that has shrunk quite a lot. And that's why we see spreads are widening. People are less willing to engage. All the other conditions are starting to become, I would say, degraded to an extent. And I'd say mainly from the willingness to participate. And I would assume that as the market moves on a little bit and we see a two-way market and we see buyers and sellers both sides, I think it will start to relent a little bit. But whether we'll ever go back to what we've seen in the past on that kind of margin, that kind of pricing, a lot of risk book stuff going on, I'm not convinced. I think that we might have had a reset here and a reset for the benefit of the industry at whole?
Wade, do you want to weigh in?
As we all know, what happened in January is very shocking or surprising. But these things has happened before. From our experience, we talk about last August or July. We have seen similar move, probably not at this level. So from that moment, we already sit down together internally. How are we gonna do that ourselves? So that's why we had some new recruitment for risk team. We have a chief dealer joined us from some other companies who has big experience than we are. We restructured the market we are trying to tap into, because I don't know, from our side, somebody asked me, what is your edge? What is your difference from other competitors? One thing I know is the spread of the market we have, because we have a Hong Kong flow, we have a flow from here. Somehow, naturally, those kind of flow net off each other, because we have some traders who long gold here, but we have some refineries in Hong Kong, they're short. So that kind of eat off some of our exposure, but not all of them. So with this structure in place in August, we'll gradually build some better ones, better framework to manage our risk. And then some aspect we offered some better deals. We also reduced the more aggressive offers, so for example, like profit share or swap free, to kind of limit the risk from beginning. But still, I can be honest with you, as I said at the beginning, 2025 was a good year for us. January, beautiful, we need to monitoring, we need to, have big balance sheet and then cash flow to manage our exposure. February, it's become better, but we have a lot of things to learn from this lesson. I think I can say we probably will review our offering very soon based on how market goes.
Anyone else? Yeah.
Well, from risk management perspective, I would say that I would summarize what has happened with gold as concentration risk has caught the liquidity off guard. So as far as I know, everyone, when they're checking liquidity bridges and risk management solutions, were more worried about markouts, about toxic flow. But everyone, almost everyone in the world of small and medium-sized brokerage have overlooked the position limits, concentration risks, and this is why some of those brokers got wiped out. And so this is just one of the lessons, and it's something that is indeed frequently overlooked, and dealers are not setting position limits. That's as much as I can say from the technology and risk management standpoint.
Yeah, I think most of the key points have already been mentioned here anyway, but obviously when you have a volatile product like gold, we saw a $1,000 move. It's impossible spreads, execution remains the same. All the counterparties behind the feed, they're going to go defensive, they're going to want to cap NOP, we're going to restrict the limits. So we saw that globally across the board. All of the tier one banks, all of the LPs got more defensive, and they just didn't want to see that overwhelming amount of flow coming in from every single angle. So yeah, there's, depending on the model that you have as a brokerage, we were discussing this earlier as well, the A-book, the actual STP or hedged flow, is obviously the construct behind that is completely different to the B-book environment. So if you are offering these terms that are swap-free, insanely high leverage, you have no choice but just to give a B-book pricing. And then the issue will come that when you need to hedge, you're hedging at a worse price and it's more cost-effective. It's detrimental to your cost. So I think there was a lot of lessons that were learned along the way. That's what's happened on the move. So now we're in a position that everyone is being obviously a little bit more defensive and trying to now manage the volatility of gold. That's the way I see it.
Yeah, I think just to add to that as well, obviously there is a structural shift that's definitely happened. You know, as Dane just touched on there, you're getting 50, 60 cent spreads from your tier 1 LPs. And, you know, retail brokers are still trying to show 15 or less cents on their platforms. So there has been a structural change. And as Wei touched on as well, there's probably been a structural change in the way clients are now trading because of those attractive conditions that retail brokers are still trying to offer. So you're seeing more directional flow from the retail client. And it's how you then go about managing that flow, like Victor just said. What changes do you potentially put in place on your platform? Exposure limits, directional limits, etc. So yeah.
Yeah, thank you. We don't have to do this, by the way, in order, so just jump in. So, Nick, you said something as well now, which is very important. You know, what you get from the underlying banks and the tier 1 LPs is way far from the retail brokers are offering to the underlying clients on a B-book liquidity. And that gap needs to be bridged, because we've been discussing the A-book versus B-book liquidity and the change in client behavior, where client is becoming a one-directional sided client. So the focus on the B-book liquidity now has to diminish slowly. It might change maybe later this year, but for now I think it's a bit risky to kind of continue down that road. So, and where you said that, you know, you've sat down last year and you've discussed and you planned for an event like this. So what are the conversations that are happening in your respective companies as LPs? What are the plans that we're putting for the next couple of weeks, for the next couple of months, on how to handle, you know, what happens after this, and if this continues to remain, how do you bridge that gap of, you know, the execution metrics, the spread, the swaps and all of that? How do you move away, if you have to, from the B-book model into the A-book model? What are the conversations that are happening on the back of this to be able to forecast, you know, where we're going to be in 6 months' time? Anyone, you know, feel free to jump in.
Yeah. My name is mentioned. So, other discussion we have, we all know gold is probably the most popular instruments, has been trading last 1 or 2 years. How can we divert this focus to something else? It's very difficult, right? Because there's hardly any movement in other instruments. So we were discussing, okay, LATAM region. I think now people also move to gold, but historically, in the beginning of last year, there's some indices focus. We're trying to say, can we offer something better to attract those flow to make our gold focus become less? That's one discussion we had. Second one, how can we have two models. One is the agency, one we call the margin. So agency model is purely credit related, dealing with liquidity between banks and the bigger guys. So how can we make that side of business become bigger so our margin percentage of revenue will not be so heavy in our portfolio? So the two things we mainly discuss. But that will involve many, many things. Infrastructure, LP, how much money you can make, forecasting you can show to the board, right? Yeah. Those things, that's two top topics mainly.
Very nice. Anyone else?
Okay. I think for us a big point about being a market maker, it's not that bad a word, is actually the way that we manage the flow that comes at us. And what we saw in January was really good environment for us. We hit the kind of figures we wanted to hit, and flow worked the way we wanted to, but come late part of January, because one side dried up, it became very, very difficult to us to continue to market make. So a big push for us right now is to try to make sure that we are pushing our product and structure in a way that we can get two-side quotes. And that's a big, big part of what we need to do. Part of that is speaking to more counterparties. Part of that is structuring the technology we use, working on things like NOP limits or that kind of stuff. Not making it so static, but being able to move it across that spectrum. So if we end up at a point where we're very one-directional in the market, we can still somehow manage to attract the other side, and that systematic internalization, that being able to cross-head both sides, becomes critical for us to still continue to provide liquidity even in these really stressed moments. So I think that's a big focus for me and for the team over the next few months, until gold gets better and everyone just goes back to normal.
Yeah, Nick?
I think just to touch on what Jay just said there as well, is that time where you've got to take stock of looking at your balance sheet, looking at the risk capital, looking at what risk limits that you've put in place. As I said a minute ago, is it directional limits? You know, do you have an overall exposure? Are you looking at revising your daily P&L cuts? Do you know what your weekend VAR risk is? Do you know what your gap risk is? All of these things now come into play because, as you touched on, the client behaviour potentially is changing. So you do need to think about all those things. It's important.
Well, I would add that nowadays, many liquidity bridges, they've introduced additional features to their smart routing, so the client trade flow can be analyzed at a deeper level, and you should perhaps look into this direction. If I were a broker, I would look into clusterization of clients based on the position holding time. Not all the holding times pose the risk to the brokerage. So only those who actually pose the risk that are holding, which holding times are longer, those should be probably externalized. And because when you are hedging and sending your flow to multiple LPs, you end up with collateral fragmentation, which you want to avoid. So you'd better end up with one good prime broker, but you would at the same time reserve some space for internalization based on smart routing and smart analysis of the trade flow.
Then, do you wanna?
Yeah, I mean, there's not obviously much left to say, right? I think all the key points again have been mentioned, maybe in the last one, but cheers, guys. But no, it's I mean, what else are we left to do apart from you know, speak to the counterparty, speak to the LPs, make sure we have the good relationships, make sure that we're well funded, and you know that we're the margin is there ready for, let's say, another big move in the market. Obviously, it goes down to what Nick said in terms of the risk levels internally, the limits that you're set. Maybe the committee don't want to open enough risk to the market, so you need to hedge more. So all of these considerations, I think there isn't really a rule of thumb. There isn't a right or wrong way. It depends on you as a broker.
Sorry. No, go. I was just saying that's a really important point, like Dan just said there. Getting to know your counterparty before you've even started the onboarding at this point is got to a critical point that you need to now start doing.
Yeah, and that's I think like my next point that we need to really emphasize, because the importance of balance sheet is becoming at the pinnacle today as opposed to any other time. Because if you're running a B-book model, you need a strong balance sheet to be able to sustain these big moves. But also, if you're running an STP model, you need a big balance sheet to be able to hold the positions with the LP, especially with the raising margins. So I think one of the main concerns, and this is our business, our business is a balance sheet business on a liquidity level. It's not the retail business. The balance sheet, you're in the credit business, and your balance sheet is what defines how much risk and how much profit you can generate. Stressing that maybe is something important. And I guess, on the back of these 2 weeks that we've seen in the market, we're going to see maybe some companies maybe going under, maybe some companies will be in trouble, and, clients will be facing some issues with withdrawals. Is balance sheet one of the main elements that we should be looking at today for clients when they want to onboard? Is it something that needs to be checked before you onboard with your liquidity provider? I mean, what do you guys think about this?
Let me jump first. So, I mean, obviously, balance sheet is one of the most important factors, so you can survive these swings depending on the model. But I think there's a lot of key points that obviously need to be considered. I think another thing that brokers overlook, and it's something that frustrates me in the market, is there seems to be a big push in just caring about the volume instead of the quality behind it. Brokers are just willing to offer these outrageous terms, infinite leverage, 1 to 10,000 on gold, swap free, all these unbelievable conditions. And it pushes the broker. They have no choice but just internalize that flow. And they're just running that significant risk. Now, what happens if Black Swan event or something, what happened that we saw last week? Then they start playing around with their pausing withdrawals. They can't pay the client. It gives our industry a bad name, and it's something that we deal with on a day-to-day basis. We spend a lot of money on setting up correctly, having the infrastructure, making sure we're regulated, for then a broker that's offshore coming along, given these outrageous conditions, and then we have to pick up the pieces with the clients to explain to them this is the real market. and I think that's something that brokers need to consider as well internally. All get together and actually bring the market back into a reasonable level instead of being this lavish casino that we seem to be seeing.
Yeah, definitely. And now is not the time to be very aggressive with commercials. I mean, I think it's something that everybody needs to be screaming at this stage. Now don't come and ask me for 8 cents of gold and swap free. It's not the time. Maybe there were better times to do that. I'm definitely not with it at any time. But now is definitely the worst time. You need to give brokers the ability to be able to manage the risks. I guess. The question is still valid. The balance sheet effect and the counterparty risk that is extremely heightened today, because at the same time where we're looking at our clients asking us for facilities and credits, at the same time we look at our counterparties and how much they can. Whether it's if you're working with a tier 1 PB where the risk is lowered, but at the same time your margins are going through the roof, which means you need to use a lot of your balance sheet to do that. Or if you're dealing with prime of primes at the same time, the risk is heightened for counterparty. So what is internally, what would you do to manage this kind of gap?
I'm not an accountant, Wei is, and he's going to talk a lot more about balance sheets. Balance sheets, to me, are a really good starting point, and you get a kind of flag in the sand because my counterparty is in a really good financial position, or I'm in a good financial position, so kind of where the two flags are, and that's where you start heading. But I also think when the markets get stressed, balance sheets are movable flags, and you don't know how much else your counterparty is facing. You don't know how quickly your balance sheet will deplete or be added to. So I think it's a really good starting point. More importantly for me is the dynamics of how your product's working. I think you want to get to balance sheet as the last resort, but you start there. So you build from the worst case and you get better, but as a last resort, I'd be looking at balance sheet. I think the product offering, very, very important, is counterparty relationships in terms of understanding what you're doing with each other. There's not enough conversation of saying, in a very simple form, I'm sending you this type of flow. The flow is going to do this. So when the market does that, you need to do that for me. And that doesn't exist. What we do right now is, what's your price? What's your quote? Where's your margin? Where's this? Okay, great. Should we have dinner? Okay, I'll just send you all my flow. Great. Until it starts to go wrong and no one actually knows what they're sending out. For me, that's problematic. You need your structured relationships. You need your game plan. What will you do when that happens? Who's going to get what? And they need to be ready to have it.
So as a qualified accountant, I think balance sheet is one item to start, as Jay said. But I think you probably focused on balance sheet when you want to offer clients credit. But if you want onboard clients just for liquidity, I don't know. We don't check too much about balance sheet. We check more about ML, right? Because if you do a book, what flow they pass on to you, you pass it out. As long as the LP pay you, you pay to client if you make money. So
but then you have a funding gap, right? So you're offering your clients 1 to 500 leverage, and then you're paying
exactly
5% to the LPs, right?
For yourself, you have to have a stronger balance sheet to meet the gap, especially if you trade with tier 1 banks. Yeah. They offer 16 to 1 for gold, probably you offer 100 to 1 to your clients. So that's one piece. But if you do B-book, I just to put some assumption. If client lost money to you, if they default, means like you just wipe out your profit, right? Yeah. That's it. So you don't have too much risk. They on risk, you're not on risk. So I'm talking about the balance sheet, right? Because you asked me.
I agree. Go on.
So the problem comes if you mixed A and B, sometimes you are on the wrong side, you manage it wrongly for the client. You had a problem, but I will be too late to talk about the balance sheet. So
Nick,
just going back to what Jay said earlier as well, is getting to know, and what I said earlier as well, getting to know your counterparty and who that client is before the onboarding is even started. And then you can, once they're live, then you look at the data metrics. What do their markouts look like? Hold times? How do they trade over news? What do they do over volatile periods, etc.? And does that match up with what they told you over dinner that the flow was going to look like in the first place? So, it's really super important. And on the retail side, you obviously don't get that luxury because you onboard the clients directly. But in that instance, you have to really know your regions and know what normal looks like in each of those regions. I think that's super important.
Can I add something?
Yeah, sure.
It's very interesting because I want to say this because it's something making me to think. I think last October or November, somebody from our industry asked me, messaged me, wait, do you know a Chinese syndicate?
Sorry, what was it?
Chinese syndicate group trading gold. I never heard of it. I asked the people around in our team in China. No, nobody knows. I think if I don't know, it doesn't exist. No, never. I mean, we are Chinese. We don't do group things. We do ping pong only. But however, now I know there is one, and also those people are much smarter probably than most of us. They are from our industry. They are probably, I probably will be killed if I would say, I know. They are hunting some people probably less sophisticated than we are. They are trying to influence the market through their trading style. So I think know your customer, not only from the paper, but also from the background, from what they are. You probably have to uncover what they have present to you.
Exactly. It goes. You have to really specialize in your regions. I fully, it's becoming more and more apparent now.
Yeah, true. I want to go back to something Dane said, which is, the quality versus quantity. And, we've been discussing just before we started this panel that there's a major shift in client behavior. I don't know when that's going to change. So there might need to be more reliance on A-book model, which means that maybe quantity now, obviously it doesn't have to be bad quality, but quantity is important because maybe you need volumes to generate transaction revenue enough to cover your expenses. And obviously with that comes, you don't have to run a traditional B-book. You can have different pricing strategies and passive hedging and a lot of things that you can increase your transaction revenue without having to take too much risk. Are you guys also having these conversations? Are you looking at options like that? It's not just A or B, it's A or A/B. Anyone would like to jump into this? I can answer if you want.
I'm not having any of those conversations. We don't do A or B, we do the in-between. And that works very well for us. We don't need to worry about whether the flow is good to sit on my balance sheet. And frankly, I'm not worried about whether it's good enough to sit on your balance sheet. If it gets through my filter, it's good for everybody. So from that point of view, no. And I would really encourage everyone to start thinking about the spectrum of managing flow, not just this kind of binary A-B decision. And actually, if we as all market participants start doing that, we will create a healthier ecosystem for all of the order flow that we essentially are circulating back amongst each other. So I think,
I couldn't agree more, Jay, and I think it shouldn't be an A-B model. The model should be a lot more sophisticated. Nick, I know you guys have delved a lot into a pricing engine and different hedge strategies over the years. What's your take on that?
My take is it depends on what side of the business I'm looking at, whether it's the institutional or the retail side. But on the retail side, I would start by looking at I would literally look at the internalization rates on the symbol level. If you're internalizing at 95, 97% in gold, you don't necessarily, all you're worried about from the market risk perspective is potentially 5 or 3%. So you need to start, as you just touched on, you need to start building your hedging strategies and changing your hedging strategies according to what you know and what you know about that symbol, etc. And that's where you start with it. Before you start looking at all the other good stuff and the systematic internalizations. Is it just an inventory limit, that kind of stuff?
As I said at the beginning, hedging strategy can be A and B. You talking with the LP, also can be which client you want to onboard, which focus you want, which kind of categories of client you want to approach. So if you have some gold players speculating the gold gonna go up, but you have other ones to hedge, that's kind of like a natural hedge for you. You don't worry too much. People probably call that a B book, but we call that net off, right? It's not B, like you in the spread. You're not paying LP, you're paying the other side. So you also need to think about, as you said, options or other way futures to hedge you. But we've been discussing probably since 10 years ago, right? My take is this: our industry, the knowledge level is not there. I'm not talking about this panel, I'm talking about all the people. You have to have a special team who has been well educated for that product from beginning to end. Otherwise, you cannot handle that. So that's why I think it stopped us to go to hedge that way.
Victor, maybe a question for you. You know, you're looking at this from a technology perspective. Have you seen a surge in demand over, risk management platforms, different technologies, maybe AI integrations, maybe to be able to manage this better?
Yeah, that's exactly what I mentioned before. There would be an additional analysis, sometimes AI-driven, on top of smart routing. So traditionally, smart routing, order routing, has been manually configured. So you want to send this client group to A book, this to B book, this to partial A book. But nowadays, I think it came from various risk management platforms like Mahi Markets and other such ones, that you analyze the client flow on the back end using AI, and you automatically change the settings in the smart routing. Some settings can be pre-configured. Broker can set the limitations, but all in all, like Wei said, there can be netting, so hedging can be systematic, or another name for it is matching engine built in the bridge. So there is a time delay, and also when you're sending the buckets accumulated from such netting, you don't send them all, you don't kind of shoot them at the LP. You're using time weight approach, time weight average hedging. So this is the combination that the brokers are asking about.
Okay. I'm going to float one small idea. We don't have much time left, so maybe we'll try kind of like give a few minutes to the audience for questions. I'm going to float an idea. So it goes retail client, retail brokers, then us, obviously, prime of primes, and then tier one liquidity providers, right? Do you think the responsibility falls on us to change the status quo or what was before, to start educating and start pushing the differences and the changes in the market, especially when it comes to gold and silver liquidity? Or does it sit with the retail broker to kind of explain that to their underlying clients? Obviously, the banks have already changed their margins, changed their spreads. Everything is coming. We're seeing it. But then, it's for us, the prime of primes, to kind of, what do we do on the next layer? How do we stream prices to retail brokers? And then how do retail brokers treat their retail clients? Where do you think, collectively, can we share that responsibility?
Of course.
Yeah, Dane?
I think this is a very important question. I think it's one of the most important questions at this current time. Is the onus, I think, is on everyone. Obviously, the tier one banks are going to always remain where they are, firm on everything. And especially for the prime of primes like us that also have a retail offering, I think it's something that we have to teach the client. I mean, look, it's been something that we've always had to do since day one. Client trades, executes a large order, has a VWAP execution, calls it slippage, complains. You're manipulating me. So there's always been a fundamental lack of knowledge and the bridge between retail and the, let's say, liquidity providers behind them. So I think, obviously, if we increase the education, I mean, surely the complaints and the kind of the market issues should overcome themselves. And I think, especially from my side, Camera as well, we want to really focus on the educational side, stepping that up, actually highlighting the key points of liquidity and what it takes to actually set up an institutional desk. And I think actually exactly what's happened in the market, I think hopefully now this highlights to the retail client just how dangerous things can get with a lack of understanding on the market. So yeah, I think the onus is purely on every single step of the way. Obviously, retail don't have to train themselves, although we would like them to, but definitely from retail brokerage up to prime of prime, the education between both of them has to be the same.
Just to touch on that, I think that Dane's got a point. As retail brokers over the years, we synthetically now had to create liquidity more and more, especially in the last couple of months. You're not getting, as Dane said, you're not getting those depth of book stacks, you're not getting those top of book spreads at any of the LPs anymore. So you're having to continuously update your synthetic liquidity to give the clients the Goldilocks conditions that they want and they desire. So there is a big education piece there that needs to happen, but this is probably now at the right time for that to happen.
I think, just quickly jumping back in, I think what Jay said earlier as well about all the counterparties in the ecosystem taking more responsibility as well is such a key thing.
Yeah, I was going to say self-education is really important. Like, let's not forget, something happens, it can happen again. We need to self-educate on what we're going to do to make sure that we don't find ourselves in a bad situation, but also maybe self-educate about what our business goals are. Are we here for longevity? Are we here for perpetuity? Or are we here to just have a couple of good years? And if we're here for longevity and we're serious about what we do, then now is a really good time to take a step back and think about what are we going to be in 5, 10 years, and not what's the next quarter going to look like.
I think for education part, as a prime, we probably have a very limited power. How can we teach the retail clients, because we cannot face them? And I think if we have to choose one, it has to be retail broker. But I believe market is the best educator. So I think many people have learned from last day of January what they are hoping, and disappoint them, upset them. That's probably best education.
Victor, you had something?
Yeah, I can add that I've seen many companies that are that could be called sales-driven, when on top there is a CEO or owner that comes from sales background, and based on these lessons that we see with gold, I should say that trading and dealing should have stronger voice in the company. Sometimes they're just toned down, and they just do not have a possibility to set those exposure caps that we're talking about, and apply basic value at risk derive method to structure their book. And so this is where education angle can come in from the LPs, from the prime of primes. And I know some colleagues in the industry are really starting doing this. So we're all interested in brokers in the industry to survive, and there can be different ways, teaching about risk management, about introducing futures that are basically more liquid than Forex in some regard. You can hedge them directly with prime brokers. So yeah, there is always a space for education.
Great. I think maybe then, we've got 2 minutes, we can do something quick. Does AI play any role today in this? Reading, prediction, pricing engines, hedging engines, Have you looked at it as a way to kind of go forward? Is it something that can actually help? I mean, yeah, Victor, maybe you'll have an insight.
Yeah, definitely. It's at Spotware we're utilizing AI quite intensely. It's we introduced trading algos for retail clients, but we're also thinking of different ways of introducing this for CTrader and for CBridge. Like I mentioned, for the smart routing and for general risk management rule for reporting, AI will be in any element and in any module, including DevOps and system maintenance.
Yeah, I think AI in terms of helping us to understand our data quicker and move quicker and make decisions quicker, absolutely. I'm a little bit skeptical about machine learning making decisions for us. I think we'll leave that to real intelligence, but being able to crunch the data and know what we need to do, it's critical. If you're not doing it, a bit late, I think.
Yeah, I agree.
I think AI definitely play a big part of recent financial market. I mean, we all know some big guys already spend a lot of money develop AI, but I'm not so sure if it is profitable. Because my belief, AI basically is a copy human, but with a faster speed. If we think we are not a genius trader, AI wouldn't be. But they probably can gain because they move faster. But I don't think that will be a long term, because if everybody using AI, you're competing AI with AI, and the end result is unpredictable. Yeah.
Right, I think we came to the end of the session. I would like to thank all the panelists for their very amazing insights and the time they've given us. And thank you all for attending today, and we thank IFX Expo for arranging this, and we'll see you next time. Thank you so much.